tariffs, uh, I think this is a disastrous policy. I have an article today in the National Review talking about tariffs. I'm completely against all sanctions and all tariffs, by the way. I'm a free trade unilateralist. So these are very damaging, and the obsession that Trump has is with the trade deficit. He wants to eliminate the trade deficit. He's a mercantilist, and he thinks the trade deficit is caused by foreigners, by nefarious activities of foreigners, foreign subsidies, foreign tariffs, foreign this, foreign that, and he wants to close the deficit, and he thinks tariffs will do it. No, tariffs won't.
Hello everyone and welcome to another edition of CEO and Market Expert Interviews. I'm your host Lucian. Most of you know me as Triangle Investor from social media. I'm delighted to announce my next guest, and that is Professor Steve Hanke, Professor of Applied Economics at Johns Hopkins University and the founder and the co-director of the Institute for Applied Economics, Global Health and the Study of Business Enterprise. Professor Hanke is an author of A Life Among the Econ, an autobiographical piece, and co-author of the recently released Capital, Interest and Waiting. I would like to point out that Professor Hanke is now rated as the third most influential economist in the world according to the Focus Economics in Barcelona. Professor Hanke, welcome to my show. I am very, very pleased to have you.
It's great to be with you, Lucian.
Thank you very much. It's not like I have every day a third most influential economist in the world in my show, so I will try to use my time in the best way with you.
Well, it's great to be with you. Just knowing that you're in Croatia, which I spent a great deal of time in Croatia in the early 1990s, and it's probably got, I think, in the Balkans the best coast available and the best fish available. I can report on that.
Yeah, you are spot on. Beautiful coast, excellent food, and I would really invite people to come. Not because it's my country, but it's really,
Oh
really
yeah,
beautiful.
nothing beats the Adriatic. It's just fabulous.
Thank you, Steve. Thank you, Professor. Let's start with the big picture, Professor. The current state of the economy, and if you can say a word or two, what are your expectations for 2025?
Okay, let's start in Europe, since you are in Europe. I'm very negative. Europe is lagging behind, and has been certainly since the great financial crisis in 2008. I've looked at the per capita GDP growth in the U.S. and compared it to the EU, and the EU is lagging way behind, and it's getting worse. I might also indicate that I did look at Croatia, and on GDP per capita, it's lagging way behind the other
Yes.
Balkan countries. For example, Serbia actually is growing more rapidly than the United States since 2008, and Croatia is lower. So Europe is in bad shape. You've got too many layers of government. The EU is just a wrecking ball, basically, just covering Europe with unneeded regulations of one sort or another, making Europe very uncompetitive. So added to that, of course, you have the aggravation of the war in Ukraine and the fact that no Russian gas.
Yeah.
So the Europe very negative for and what I see coming this year is going to be a great deal of fiscal and political chaos because President Trump, has indicated that he wants the NATO members to increase their defense expenditures up to 5% of GDP. And the European countries, they just can't afford it. They don't have the money. So this is going to create a tremendous amount of tension, I think. And the main countries in Europe, for example, France is in a fiscal mess right now. Germany is in a complete fiscal mess. They're even debating in Germany about getting rid of the German debt brake. This is a big issue in Germany. And you have an election coming up in Germany this month, later this month. So we'll see how that develops. So a lot of political instability, a lot of fiscal problems, and a background of low productivity growth, way too many regulations.
Yes.
So that's Europe. The United States, I anticipate, by most measures, the biggest economy in the world, not on a purchasing power parity basis. China is bigger than the United States, but the U.S., I think, will slow down this year. And the reason for that is that the money supply has actually contracted and is a little smaller than it was in the summer of 2022. So with that, usually what happens, we've only had 4 times in the U.S. where the money supply has contracted. And what happened? We always had a recession. Or in one of the 4 cases, 1929 to 1933, we had a Great Depression. So I anticipate that based on the quantity theory of money, because that is the most reliable model to forecast and indicate where the course of nominal GDP, and nominal GDP is real GDP plus inflation, where that nominal GDP is going. And I think it's going to be slowing. So that's the U.S. China, the second or the first biggest economy in the world, is in trouble. Again, based on the quantity theory of money, the money supply should be growing at about 11% per year if China was hitting its inflation target of 3%. Well, it's growing at about 7% only. And that's why, what is the inflation in China? It's 0. It's not 3%, it's 0. So China is in trouble, and they're feeling the pain of the housing crisis and real estate crisis, which is causing the private sector in China to deleverage. Tremendous amount of deleveraging going on in China. And at the same time, normally, if the private sector is deleveraging, what happens? You usually get more leverage coming in the public sector, but that's not happening in China. So I think China will stay slow. So you've got U.S. slowing down, China staying slow, and Europe really in the tank. So the picture doesn't really look that great.
Yeah, unfortunately not. Great overview on Europe especially. And you mentioned money supply. I want to touch a bit on the money supply. The US, I mean, the Federal Reserve's balance sheet has undergone significant changes since 2007, reflecting its response to a major economic crisis we had. From a modest zero point 0.9 trillion US dollars at the end of 2007, it ballooned to approximately 6.8 trillion US dollars by February 2025. So my question is, where, how, and when this ends?
Well, I don't think it will end it because what happened, you explained the acceleration when the balance sheet went up and the money supply actually peaked out. It was growing after the COVID pandemic. They accelerated tremendously, and the money supply was growing at a peak at 17% year over year. That's the highest rate the money supply measured by M2 has ever grown in the United States. And that is about 3 times higher than Hanke's golden growth rate of 6%, a rate consistent with hitting the 2% inflation target.
Yeah.
So we went way over the inflation target, and John Greenwood and I predicted that we would go up to at least 9% inflation. We peaked out at 9.1%, and then the Fed reversed things and put on the brakes, started shrink. We went into quantitative tightening and start shrinking the balance sheet, and that's a contraction that I was talking about, Lucian. And that contraction now, the money supply is growing at over year over year less than 4% per year, and the golden growth rate is 6%, consistent with hitting 2% inflation target. So we're a roller coaster, up, down, up, down, up, down. And why? And why do I think that will continue? Because the Fed ignores the quantity theory of money. The chairman of the Federal Reserve, Jerome Powell, has testified many times that the Fed believes that there's no connection, no reliable connection between changes in the money supply and changes in real economic activity. So this is, if you ignore the money supply, the game is over. And you will keep having the roller coaster, up, down, up, down, up, down.
Agreed. Unfortunately, agreed. Let's analyze the first 25 days of Trump's presidency. How do you see his steps on the foreign and domestic front, with special reference to tariffs as a hot topic today?
Well, so far, it's been what they call in military terms the shock and awe approach. Or in sports, I mean, you're big in basketball and Croatia and neighboring countries. He's flooding the zone. He's flooding the zone. So it's just one thing after another. Now, you mentioned tariffs. I think this is a disastrous policy. I have an article today in the National Review talking about tariffs. I'm completely against all sanctions and all tariffs, by the way. I'm a free trade unilateralist. So these are very damaging, and the obsession that Trump has is with the trade deficit. He wants to eliminate the trade deficit. He's a mercantilist, and he thinks the trade deficit is caused by foreigners, by nefarious activities of foreigners, foreign subsidies, foreign tariffs, foreign this, foreign that, and he wants to close the deficit, and he thinks tariffs will do it. No, tariffs won't. The trade deficit is made in the USA. The U.S. has a savings deficiency. That means savings is less than investment. Most of that savings deficiency is caused by the federal government's deficits. That's where the deficiency comes from. And as a result, we have had 25 years of trade deficits, but they've been caused by the fiscal deficit and the savings deficiency that exist in the United States. So what happens? How do you fill the deficiency? You fill it by importing. Yeah. And we can do it because we can finance the imports without a problem. So if Trump really understood this savings investment identity in economics and how it worked and what causes trade deficits and trade surpluses, he would just balance the federal budget and the trade deficit would go away. If he actually wanted to do that. So he doesn't understand how this works. Let me reverse it. We have a savings surplus in China. Why do you think China has such a huge trade surplus? Because they have a savings surplus. Why do you think Japan has a trade surplus? because they have a savings surplus. Why do you think Switzerland always runs a trade surplus? Because they save a lot. Same with Germany. So, these trade imbalances are always homegrown. They're produced at home, either the surplus or the deficit. Now, what do tariffs do? Of course, tariffs distort things. If the U.S. puts tariffs on, that will simply mean it won't change the overall deficit. That is given by the savings, investment, and identity and the deficiency we have in savings. The tariffs will just move who is filling that deficit around. So instead of getting so much in terms of goods and services from China, we'll get more from Indonesia and Vietnam and different other places. So that tariffs are just a complete disaster. and by the way, when you run the numbers, which I've done, it means that between about 5.5% and 27%, that's a big range, but still, if that will be the cost for household income, it'll be minus 5.5 to minus 27. Something in that big range will make Americans poorer. Tariffs make Americans poorer. So that's the story on tariffs. I'm very much opposed to these.
Yeah, so the small people are the biggest losers from these tariffs,
Yeah,
obviously.
Small people, the people that are going to Walmart and buying imported goods from China, they're losing. People going to the grocery store and buying bananas from Ecuador and avocados from Mexico, they're losing. And most people don't realize exporters are big losers. American exporters will be big losers because the exporters actually import a lot of inputs they use to make whatever they're exporting. And those things will increase in cost and the exporters will be damaged. So the exporting thing is just bad news. The one other big thing that Trump is very clear about, he's very clear he's a mercantilist. And of course that was popular in the 16th and to the 18th century around the world. Most everybody were mercantilists. They thought if you were running a trade surplus, that was good, and if you were running a deficit, that was bad. And most businessmen, by the way, have this idea, this mercantilist idea, because they think a country is analogous to a business. And with a business, of course, you want to be selling more and bringing in more revenue than the cost going out. So you don't want to run a deficit, because if you do, you'll go bankrupt if you're running a private business. That's not the same way as a country. This is a fallacy of composition, they call it. You can't go from the small business to the nation in an analogous way. They operate differently.
Yeah.
So that's one big idea that Trump has, and another big idea and that's a bad idea. A good idea that he has is to reestablish sovereignty in the United States and control a border. And that he's making big moves in that regard. So that's a big deal, and that's good. He's got this Elon Musk in there with what they call DOGE, Department of Government Efficiency, and he's shutting down USAID, which all the scholarly literature is showing that USAID has been a corrupt operation since day one. So he's made correct moves there. Now, the larger geopolitical things, and the thing that's most interesting for Europe directly is he wants to shut the war down in Ukraine. and it looks like he's going to start negotiating with Putin on this. And the Russian position is very, very clear. Number one, objectively, the war has been already won by Russia. They occupy the four big Donbass regions, and they will demand that they take those. That'll be one thing, and that Crimea is retained by Russia, and that Ukraine never goes in NATO. Those are the basic demands, and Putin won't move on those. And I think it looks like, given the signals that are coming out of the Trump White House, that Trump's going to more or less go along with those, and the war will come to an end. The exact details of the peace agreement we don't know, but
Yeah.
it looks like those elements that I just went over, those two elements, will be in the picture, and Trump will accept them.
Yeah, that could happen. Professor, I read yesterday that the Bank of America CEO thinks that stronger consumer spending so far this year means that the Federal Reserves will probably hold off on cutting its benchmark interest rate. How are your views on the interest rates going forward?
Well, first of all, monetary policy is about changes in the money supply, not about the interest rate. So you shouldn't really be focusing on the interest rate. It's kind of a second or third order factor. Everybody focuses on it. The first order is, what about monetary policy's effects on the money supply? The big thing that the Fed should really be doing is stopping quantitative tightening, because the money supply is growing at less than 4%. It should be growing at about 6%, so that they could hit the inflation target of 2%. So so that's the background. But where you ask a question, well, what's my view of where interest rates are going? To find that out, you just go to the federal funds futures market and the Chicago Mercantile Exchange, and you see objectively what people who are in the market with money in the skin in the game, as they say, what they think. And it looks like they think that the next two Fed meetings there'll be no change. And there's and in the third meeting, they think there's a less than 50% chance that they'll reduce the Fed funds rates by 25 basis points. So the market is basically agreeing with the chairman of the Bank of America, and I just look at these probabilities in the Chicago Mercantile Exchange. I don't listen to the chairman of banks or analysts or anything like that. It's a waste of my time. I just look at the market, and you have the exact probabilities, and that's it.
Yeah. What about debt ceiling? House Republicans unveiled blueprint to extend 4.5 trillion in tax cuts and lift the debt ceiling. Do you believe that the debt ceiling will be removed permanently? And what would be the implication of such action?
Well, I think the debt ceiling is kind of a sideshow. And what I think should happen is that the United States should, using Article 5 of the U.S. Constitution, have a constitutional convention. And at that constitutional convention, the focus should be only on one thing: changing the U.S. Constitution and putting in something like a Swiss debt brake. And the Swiss debt brake was put in after a referendum in Switzerland in 2001, and 85% of the Swiss voted for the Swiss debt brake, which requires the Swiss to balance the budget. And there's a second condition, and the second condition is that the growth in the government spending cannot go up any more rapidly than the growth rate in the economy. And that means that the size of the government in Switzerland relative to the total size of the economy can't change over time. In other words, the government in Switzerland can't crowd out the private sector. So
That's
that's
a
what
good
I
answer.
think. And the reason for this, Lucian, the reason that I want the Constitutional Convention, actually, I'm in a board member of a group that the Foundation for Fiscal Stability, and we're pushing for this. And the reason for it is that any statutory change or changes in debt limits, things like that are statutory, they never work. It's like a Band-Aid. The Band-Aid comes off. What you need is a change in the Constitution that makes a thing in stone.
Great overview, but Professor, what about monetary systems? How do you see the world's monetary systems in the future? Actually, my question is, how can they be transformed? And is there any minimum of political will to transform them?
Uh, there's not much political will. It's in other words, to transform the international system. Now we have what Jacques de Larosière, my good friend in Paris, who, as you recall, was the governor of the Banque de France,
Mhm.
managing director of the IMF for 10 years, and also the president of eBird. And by the way, he's a fellow at my Institute for Applied Economics, Global Health, and the Study of Business Enterprise at Johns Hopkins. He's 95 years of age and still going strong. And he wrote the
Wow.
preface in my new book that'll come out in April that's called Making Money Work. And it's very clear, according to him, we have a non-system now. There is no international system. There was an international system that was put in with the Bretton Woods Agreement after World War II, and then that was abandoned. That system was roughly a system of, shall we say, linked exchange rates. It wasn't, they weren't fully fixed, but they were pretty tightly linked together. But we've abandoned that system, and we have a non-system. And right now, I don't see any serious discussion about uh,
Changing.
introducing some new system. That was your question. I
Yeah.
don't. I mean, there are a lot of theories, academics that talk about it a little bit. But you said political. That was the way you started your question, and I see nothing on the horizon.
Yeah, probably nothing. Professor, a lot of my guests that were in my show agreed that we live in the multi-bubble world now, starting from the overvalued stock market, cryptocurrencies, even the real estate has a lot of red flags. Would you agree on that? And what is the biggest danger, in your opinion, as a bubble? I mean, which could burst first?
It's a little bit hard to predict because if you look at the U.S. stock market, which of course, if you look at the U.S. stock market's weight in the international indices, it takes up about 70% or more of all the equities in the world. So the elephant in the room is New York, and what you have in terms of valuations, any way you want to value it, and I have my own bubble detector, and the stock market is in the bubble zone right now. But all these metrics and measures for bubbles indicate that it's overpriced, overvalued, and overhyped
Yeah.
also. So, uh, but it's always very difficult to predict when a bubble is going to pop. Now, if you look at Bitcoin, that's another thing you mentioned. Bitcoin is almost by definition in a bubble. just by the nature of it. It has no fundamental value. It just has speculative value. So you never know what's going to happen. And then we've got these wars going on. We mentioned Ukraine. You've got the Middle East, and the threat against China by the U.S. to go to war. So if nothing else, there's a trade war. And my view is that it's a year that will be investing dangerously. If you're in risk assets, you're investing dangerously this year with all these things. And I think investors are just too complacent. None of these things are priced into the market. The bubble detector, obviously, that isn't priced in. The Bitcoin thing isn't priced in. I mean, you actually have governments now. The government, the central bank governor in the Czech Republic has said that he's thinking about investing in Bitcoin. That's a central banker. So when central bankers start talking about investing in Bitcoin, or in the United States, the U.S. Treasurer, the new head of the U.S. Treasury is talking about setting up a sovereign wealth fund that will invest in Bitcoin. So you know you're in trouble when you get officials starting to talk like that.
Yeah, agreed. Professor, I want to hear your take on gold, especially the gold performance in this tariffs context, trading war context. How do you see it going forward?
It's going up. I've been a bull. I've been a bull ever since this bull market started, and I think I'm not saying we're in the early stages or late stages of a bull market. We're just in a bull market. And if you're trading, all you care about is the direction of things. And the direction is up. It's going up. And by the way, there is something that I can talk about a little bit. There's something called the Hanke gold sentiment indicator. And what Abe Kaufness and I do, we text mine every article that comes out on the internet every hour that mentions gold to see if the article's bullish or bearish, and we get a reading. It can go from very very bearish to very bullish to neutral. And what we found, we've been running this text mining and the sentiment measurement now for 4 years. And when you have real extreme readings on the Hanke gold sentiment indicator, let's say it's very bearish. It goes very bearish. That means what? It means no. You don't add to your short positions. You take the short position off, and you actually go long because it will revert back to neutral and more over to. But it swings back and forth, back and forth. So if it's very bullish, what do? You get your long position, you liquidate it, and you go short, and it goes back and forth. So that has been a very valuable short-term trading. That's a trading, that's not an investment. That's a trading indicator, or it can be investment, because if you're thinking about adding to a long position because you fundamentally think gold's going up and you want to add to your position, when do you do it? You do it when the gold sentiment indicator is way over on the bearish side, and you enter the market at that point. Now you can find this by going to www.goldsentimentreport.com. So for your viewers, you can put that up, www.goldsentimentreport.com, and you can find out about the Hanke gold sentiment indicator. And
that could be very useful. Agreed.
From a trading point of view, you can do very well, making a lot of money if the market over a long duration, over a year, let's say the market never moves, the price at the end of the year is exactly where it was at the start of the year. You can still do very well because there's huge volatility in the market all the time. And even now, even as the market's going up, it's a lot of volatility up and down, up and down. But the trend is going up because the fundamentals are solid.
Yeah. Professor, let's wrap it up with this. I want to thank you for coming to my show. It was a brilliant chat, as I expected. Learned a lot, and I hope to host you sometime soon again.
Well, this will be great. Thank you, Lucian, for inviting me.